Morning to all and welcome back to Boutiques on Wednesdays. I must thank you all again for attending our conference last week. It was absolutely great having so many of you online and especially seeing so many of you in person again. It was really wonderful. A link to the CPD certificates started going out yesterday. I hope you've all received it. If you have not, towards the end of the week, give us a shout and we can look into it. We've been beating the drum on SA fixed income for some time now with super attractive yields. And despite the hectic rate cycle that we've had over the past 12 months, income funds still delivered in excess of about 7.5% as at end of April. We do believe that there are far more magic to come, but you need a manager that can navigate the fast-paced, ever-changing cycle very actively. When I started in the industry, and if you looked at fixed income funds, the choice was almost simple. Is it cash or bonds, or a little bit or less duration? The landscape since developed into so much more, with managers having to consider numerous instruments like floating or fixed rate notes, local or global credit, structured credit, inflation-linked bonds, to name but a few, while keeping your eye on risk management. In an attractive yield environment with so many options, you do need a well-experienced fund manager with uber experience to cover this all. It is thus my pleasure to welcome Bronwyn Blatt from Granate Asset Management, who does exactly that, finding the best possible returns for you and your clients while navigating this fast-paced, changing landscape. Bronwyn, thank you so much for joining us this morning again. We saw you at the conference, but it's always good to get a new update. Like I said, things are changing very quickly, and good to see where you will find those opportunities and how it comes together in the Granate BCI Multi-Income Fund. Bronwyn, if you're ready, you can share. Yeah, it's coming through.
Good morning. Sorry, I was just trying to get my presentation up. Good morning, everyone. Thanks so much.
Fantastic.
For that great introduction, Eugene. It's good to be back. I know Eugene said that they've been beating the drum about fixed income. So hopefully, and I know you're all at a conference last week hearing a lot about it. So hopefully this won't be too much repetitive stuff and something different. Okay. Sorry, I'm just trying to move my presentation. Oh, there. Thank you. Okay, so today we're going to chat about four things, four simple things. Firstly, what you can expect from this fund. Secondly, why at the moment we don't think fixed income is boring, especially after the turbulent times we've just come out of. As Eugene mentioned, we're seeing yields past 13 years across the curve in excess of 12%. So how do we navigate that environment? Thirdly, how we have a very extensive toolbox with which we use to invest. And finally, where we are seeing the compelling opportunities right now. Okay, so what can you expect from this fund? We are very cognizant of risk-adjusted returns. So this slide basically shows the Granate BCI Multi-Income Fund with 7 years worth of performance against the All Bond Index and against the various competitors in the multi-asset income space. Now, what we focus on is trying to get the highest possible Sharpe ratio, but at the same time, kind of not impacting returns too much. And you can see that over the long term, we have achieved this. We've been able to beat the All Bond Index, but at much lower risk. And I think, the All Bond Index is set out to achieve around inflation +3. If we as an income fund are aiming to achieve inflation +3 or STEFI +2 through the different cycles, and we're able to outperform the All Bond Index and competitors, the yellow dot is obviously the median set of returns for the universe, then we are doing our jobs well. So that is essentially what you can expect from this fund. I'm always asked, a fixed income is so confusing, just make it simple. So the most simple way of putting it is inflation plus 3 at lower risk than the all bond index. Okay. Why are we not finding fixed income boring at the moment? I mentioned that yields past 13 years across the yield curve are at an excess of 12%. And it's often good to look at history and then compare where we're at today. So if you look at this graph, this is basically annualized returns on a rolling monthly basis since 2002. And as you can see, we've gone through many different crises over those 20 years. We've gone through the global financial crisis 1 and 2, the Eurozone crisis. The worst time for the bond market was Nenegate, when our finance minister was fired. That's probably the worst annualized returns we've had. Second to that was COVID. And now we're actually at a very similar stage where we've had our dear friend Eskom draining the bond market of all sorts of, growth kind of impact in the economy, which will obviously impact the long end of the curve. And then we've had the latest Russiagate scandal. So we're almost at levels we've seen in history where bond returns on a rolling annualized are negative. Now, I've been asked before, if bond yields are offering 12%, and you can see the red line historically has offered around 10%, then why don't we just invest in the all bond index and sit back? And the answer to that is because we have to manage volatility. You can see the swings around the red line, the swings around this asset class is the volatility in the bond market. And we have to choose our entry points very, very carefully. We can't just back and experience the volatility in the income fund, because income fund investors are looking for that consistency, as I've mentioned. So we have to choose our entry points carefully. We also have to make sure that when we go into the bond market, we are sure that the bond market is pricing risk or price the amount of risk that the bond market is pricing in. So, for example, we will look at our valuation models. The bond market currently is offering 12%. If our valuation models are telling us that bonds should be offering close to 11, then there's positive risk compensation. We are receiving a % extra of safety margin. So it's very important to determine what type of risk the bond market is pricing in. And at times like these, when there's lots of emotion in the bond market, we have to look through that emotion and look at the actual valuations and determine whether bonds are cheap or expensive. As I said, with 12% at the moment, we are seeing bonds as very cheap. I'm sure you've heard this ad nauseum from all the people on the panels last week as well. But to put it more simplistically, if you look at, this is a histogram of the Albi returns over time, and you can see these are the different observations sort of over the last 20 years of annual returns over time. You can see that most of the returns fit in the 5 to 10% bucket or the 10 to 15% bucket. And this is obvious because most of a bond's return comes from its coupon. So it comes from the actual income return of the bond. So you would expect that most of the observations for the all bond index would be between these two buckets. But look where we are today. We're at below negative returns. So we are betting on a return to normality. We are saying that given the cheapness in the bond market, given the fact that a bond's return is very certain, it's made up of mostly its coupon return, the likelihood of it returning back to a return bucket of 5 to 10, or more likely 10 to 15, is very, very high. So in a nutshell, everyone else, we're saying that those are cheap. But we don't only look at government bonds. We look at many, many different, as Eugene mentioned when he introduced me, we look at many, many different instruments in the fixed income market. And it's very, very important to be flexible and nimble amongst the different asset classes. So to not only invest in one asset class, but to utilize all the different opportunities. And they're very, that's why, again, the bond market's not boring. It's not just one asset class. It's many different asset classes that we use depending on the cycle that we're in. So some of them are money market, corporate floating rate, corporate fixed rate, inflation linkers, SOEs, structured type exposures. And we even employ swaps and options to kind of reduce or protect against downside risk. So there's many different opportunities bond market, and our job to determine backdrop cycle, appropriate mix of classes. Okay, so this is our toolbox. We used the analogy of a toolbox in the previous slide. Our toolbox in action. So this is what the Granate BCI Multi-Income Fund has looked like since inception. It was launched in 2016. As you can see, we were in an environment where we had very, very high real yields in the economy. We also had wide credit spreads. So credit or floating rate credit, which is your corporate bond type instruments, were an obvious place to be. You could easily achieve inflation +3 by just investing in credit and money markets, which is that gray bit at the bottom. So that was what the fund mainly consisted of. And then as time went on, obviously things changed and the swap bond curve narrowed, which meant that we had opportunity to employ more fixed rate credit, which is that red bit coming through. And as we're moving more towards COVID, we saw credit becoming more expensive, sort of government bonds starting to offer better value. And then the COVID crisis just completely changed everything. The yield curve steepened, the repo rate was cut by 300 basis points, and we had to move the fund. It was absolutely imperative that we just didn't sit in floating rate bonds. We moved into other asset classes. And you can see that orange bit is inflation linkers. Now, this is obviously a controversial asset class. It often comes up in various panel discussions that I've been on, where we believe that inflation linkers are a very, very, very good asset class for income funds. You obviously have to pick the right points across the curve, but we saw a lot of opportunity in inflation linkers. We increased that. We also increased our exposure to government bonds. And as you can see, we reduced our exposure to money markets. SOEs were also looking attractive. That's another kind of, with all the Eskom stuff going on, everyone always asks me like why we liked Eskom during this time. And the reason for this was you're getting a 200 basis pickup versus your traditional bank bonds or other types of corporate bonds. So it was worth taking that risk. And also given the government guarantee, we did invest quite significantly into Eskom. So that's kind of, how we managed the fund shortly after the COVID crisis. Now what's happening is that with money market rates having moved up so significantly, we're also seeing the FRA curve pricing in more hikes. Money market is looking very, very attractive. And by money market, I mean sort of NCDs, that type of asset class. In your 1 year space, you're getting 950 for a bank NCD, which is a liquid instrument. I mean, that's very. Also seeing, the swap curve pricing in quite significant hikes, which means that further out on the NCD curve, there are also opportunities. So as you can see, what we've done in the fund is move up that NCD exposure, being that gray bit at the bottom. And things like, inflation linkers are also looking attractive, particularly on the short end. I always get asked, don't you worry about inflation coming off? We don't actually worry about inflation coming off because it's, it's in the short end of the curve. So we rather focus on total return. What we've seen in the government bond space, in the inflation linked bond space, is real yields close to 4%. So if you're thinking about, trying to achieve inflation +3, you're easily getting that from inflation-linked bonds. Unfortunately, local credit's still looking very, very unattractive with spreads very narrow. However, the base rate is giving you kind of a positive real yield, which means that there are floating rate opportunities that are coming about. But where we're seeing more opportunity in the credit space is in the offshore. Okay, so offshore credit spreads, obviously with all the Fed hikes and the noise around inflation, offshore yields are looking very attractive, and you can access those yields by investing in names that we know very well, like Eskom. Some other examples would be Anglo-American and Bidvest, and access those counterparties in the offshore market at yield enhancement compared to what we're getting here. We can also access the sovereign. Anyway, so I'm talking a lot on the slide. Let me move on. This slide basically just tells you the contribution to returns from the different asset classes, and you can see how the fund changed significantly. The actual contribution became much more widely spread given the environment we're in 2020 and 2021. Inflation-linked bonds, that blue bit, was a big part of the contribution to this fund's return. And then the last bar, if you cast your eyes on the last bar, which is all the different asset classes, you can see that that pink portion of that bar is floating rate credit, which will always be, we deem, a good asset for an income fund to invest in. It gives you that consistent positive return as long as you don't introduce default risk into your fund and you have done your credit work thoroughly. The credit universe does provide the right type of return for this fund. So we really hope that the market will return to normality. We hope that we'll be able to access opportunities in the credit space. At the moment, the market is subdued. There's just too much excess demand for this asset class, and as a result, credit spreads are very low. So hence why the fund is very balanced at the moment, away from floating rate credit and more into other asset classes where we're seeing better opportunities. I could go into all sorts of reasons, crowding out, et cetera, but I won't do that. Just to say that we think it's more appropriate in this environment to have a more balanced fund than in previous cycles. Okay, so now I'm going to move on to some of the opportunities that we've been seeing and that we have implemented in the fund. So I mentioned how offshore credit is attractive, and this slide shows exactly why. So we've had in the local side credit spreads trending downwards for a very long time, for as long as I can remember. And anyone who knows me knows that my background is in credit. I do love the asset class, and I think it's a great asset class for this type of fund. However, the South African market is just not offering opportunity. We're seeing more and more or less corporates coming to the market, listing on the market. We're rather seeing private placements and things like that. So unfortunately, we are not seeing local credit spreads as attractive. And as I mentioned to you, we hope this will change. However, in the offshore market, you can access names that we know and understand, and in a South African context are almost, I won't go into the rating, but we understand the credit fundamentals of these companies. We're not going to go and invest in companies that we don't understand, that we haven't been through a thorough credit process, we haven't taken them through our credit committee, et cetera. So it must be something that has been vetted by our investment and credit committee, and names. This example is Anglo-American. You can see how Anglo-American spreads and the credit default swap market, as the emerging market fears were raised due to the Fed being behind the curve, et cetera, there were times when these spreads blew out. We're now at another stage where we are seeing opportunity again in certain corporates. Other examples are banks, local banks that have issued in the offshore market. We saw sort of some tier 1, very interesting spreads from local banks. So a bank that we're very comfortable with, know and understand, that spreads blew out, and that was an opportunity for us to enter into that market. So we've actually moved our exposure. For a very long time, we had 0% to the offshore credit space. We've moved it up to, it's about 8.5 at the moment. And this month especially, there's been some great opportunities emerging with all the sort of South Africa risk coming to the fore, over Eskom and Russiagate, et cetera. We have found some very good opportunities in the offshore space. This just explains that more. If you compare sort of the offshore credit spreads on the South African Euro bond in the form of a credit default swap versus what we've got on the local side in the 186 and the 2030, which are our local government bonds. There is a big gap between the two. And we are taking advantage of that anomaly. Okay, inflation linkers. So we are at levels where we haven't seen for 20 years. Okay, so that doesn't really mean a lot because most would argue that, yes, you've also seen very, very good levels in the nominal bond market, so the actual government bond market, not just the inflation linked. Obviously, you have to look at the two in comparison, and many would argue that in the nominal bond market, there's a very, very wide inflation risk premium that's priced in, and therefore inflation linkers aren't attractive. So let me just explain to you how we think about this. In the front end of the curve, we have seen, and the inflation link curve, we have seen real yields close to 4%. Now think about our benchmark being inflation +3. A risk-free asset, in other words, 2 to 3 years to maturity at close to 4%. I have never in all my years of managing fixed income seen yields this attractive. On a total return basis, even if inflation does fall to 4.5%, which is highly unlikely, given kind of the backdrop of the rand and what we're seeing around the inflationary pressures at the moment, it's highly unlikely that you aren't going to receive a total return on a risk-adjusted basis that is extremely attractive. So we haven't been investing in the short end of the inflation-linked bond curve for a while, and our exposure to inflation linkers is about 17%. You know, it's always an ongoing debate whether we prefer linkers to nominals, but I think the message must be clear that we think a balanced approach is appropriate at the time. The inflation linkers are an inflation hedge in this environment where things are so uncertain. You know, we've just seen the rand blow out to 19.5. Inflation linkers are a decent asset, and they're often very uncorrelated to nominal bonds. So when you have a very bad performance in nominal bonds, you have very good performance in linkers. So it's a good balance to have especially yields. Okay, and then the last bit I'm going to talk to you about the opportunities that we're seeing is on floating rate assets. So what we've been doing in the fund is moving, you know, we were very, very heavily weighted in fixed rate type assets after COVID. And as the market has changed and as the swap curves moved up and as real yields have become more positive again, and this graph is showing how real yields are positive, you can see from 2020 to, you know, the beginning of this year, how CPI was above the 3-month JIBAR index, meaning we were in a negative real yield environment. Now that's a very hard environment for an income fund manager to navigate. Whereas now we're coming back to normality, monetary policy is tight, and we think will stay tight for a while. Therefore, we see yields, i.e. the base rate in the economy, as positive. Any spread above that, you know, is there to compensate you for that additional risk. And that's what our job is, to try and determine whether that spread is fair or not. So we are seeing opportunities, and this is just very generic, and floating rate credit, whether it be offshore. I've spoken to you about all the opportunities in the offshore space, but just to say that floating rate type assets make more sense at the moment. So we will start to be moving into these floating rate type assets more and more. And you will see how, you know, the duration in the fund has reduced as well as we're moving into these. Okay, this is just more, you know, more of the reason why. I mean, not to go into this, but we always look at what the FRA market's pricing in. We then compare it to what we think is, you know, where we think JIBAR is going to go. In this instance, we kind of are on the same page as the FRA market. Often we differ quite significantly in terms of if the FRA market was pricing in more and more hikes, but we believed that the repo rate was going to be stable or going negative as we saw inflation coming down, it would mean that we'd want to be in floating rate bonds. At the moment, we're kind of agreeing with what we're seeing in the FRA market. We're kind of agreeing that we think we'll see further hikes. And we think that the SARB will keep monetary policy tight for a while, given all the local factors around Eskom feeding into inflation, etc. So we feel, again, very, very comfortable that we are in floating rate assets, and floating rate assets do float with JIBAR. In other words, they carry no interest rate risk and therefore are a very good asset to have in this fund. I think I won't take you through this, but essentially this is just how we look at valuing all the different types of assets across the curve. So we will value everything on an equivalent floating rate basis. In other words, taking a fixed rate bond, overlaying a swap, you get to a floating rate. Everything that we think about is in terms of that floating rate. We're looking for STEFI +2, so every single opportunity that is across the curve. So in the longer end, it might be longer bonds with swap overlays. In the medium term, it might be SOEs. So that's kind of how we think about valuing the different assets that are available to us. Okay, the final bits, I think I've got about 4 minutes, are just on the current fund positioning. Tell you where opportunity income is changing area to be invested in, but in terms of where we are currently positioned, our fixed rate bond position is now for the first time below 30%. We had an excess to 40% during COVID and fixed rate bonds. We've the float portion on the side will be the other asset class that's quite interesting is your hybrid or A tier 1 type asset class, which we have reduced quite significantly. We're seeing a lot of opportunities in this asset class during COVID, and we've reduced that quite substantially. Listed property, that's one that's always very controversial at the moment. Listed property, we are seeing opportunities. We've got quite a high weighting in our balance, around 16-17%, which I know differs from a lot of the people in the market. And we employ that view in the income fund, but at much sort of on a risk adjusted basis, much lower weighting. So we'll never go over 1% in a particular property counter, and half of that's offshore, half is local. Money market, just to give you an example, during COVID, money market was around 5%. We're now at 16.2%, as we're seeing more opportunities in the money market space. The duration profile of the fund has come down. It's it's about 1.3 versus about 1.6 during COVID, and that's just the nominal duration. If you include ILBs in that, it's obviously higher and closer to 2. I looked at the yield on the fund this morning. The yield on the fund was about 10.14 thing. Obviously, with the recent sell-off in the bond market, the yield has increased. And given what we're seeing, going forward in terms of what we deem bonds to be very valuable, we think there'll be some form of capital return in this market. We're expecting, that we could achieve 11% in this fund. I always get asked that. I don't like to kind of say for definite, but that's how we are seeing the landscape at the moment. The final slide is just on sector positioning. I've probably taken you through most of this. We look at the modified duration or the interest rate risk in the fund per the different buckets, and measure it per the different buckets. And make sure that we are aligned compared to where we are seeing value across the curve. Okay, so just to end off, I think there's 4 points that I just want to quickly take you through, which we think is the reason why we have been consistent performance space. Is firstly that we are flexible and nimble. We understand all the different asset classes. We use all the different asset classes. We're always looking for anomalies in the market and to employ them in the fund. Secondly, we will use duration, but it won't be binary bet. And by that I mean we harvest returns across appropriate areas of the curve at the right entry points. So it's not kind of swinging for the fences in terms of duration, but rather harvesting returns across the yield curve as there are those opportunities. Credit. We have a thorough credit process that's proven itself over time. We have a solid credit committee. We have a solid investment committee. Each and every asset that goes in this fund is looked at fundamental credit perspective. We want to be sure our money will be paid back, and we will not invest if we're not being compensated fairly, which is the case at the moment in terms of credit spreads. And then finally, each and every asset uses our risk compensation philosophy, which means that depending on the type of asset it is, we have different ways of valuing those assets, and each asset will be looked at from a risk compensation perspective. In other words, what is the fair value, and then are we receiving positive risk compensation based on where the fair value is. So that's it's in a nutshell, those 4 factors of why we think we have been able to achieve positive, consistent returns over time. And yeah, hopefully we'll continue to do this. And then this is our Granate team. Thank you very much for listening to us today.
Bronwyn, thank you so much for that. Before you started the session, I probably had about 13 or 14 questions lined up for you. And as you progressed, I think you answered all of them, mostly all of them. So well done with that. And I mean, your benchmark is a very stiff benchmark, inflation +3. This fund, in my mind, is definitely a serious contender when you construct income portfolios or fixed income component within your cautious or balanced mandates. Very few funds that actually cover such a broad spectrum of instruments, especially on the credit side, where you said yourself, there's a lot of opportunities there. And from our perspective, when we look at portfolios, that's always a bit of a conundrum, how much credit to add. And if our audience out there, if you also struggle with that, then here's a good fund that already looks at that for you, and it is included in the fund. Bronwyn, maybe an unfair or very tough question, and it's something that comes up with clients and our audience dealing with clients very frequently, and we understand why. If you look at bank fixed deposit rates, very attractive at the moment, and we know why, because you showed a couple of graphs, floating rate notes offering good yields, bonds offering good yields. So banks offering clients roughly about 11% effective at the moment. If you look at nominal, closer to about 9.5%. And this is something, we know you lock in for 5 years and you lose liquidity with a bank, but some clients are happy to lock in for 5 years. My question to you, do you think in a fund like yours, there's enough legs in the different instruments to possibly outperform those kind of rates that the banks offer over the next 2 to 3 years, and then still leave a client with a lot of optionality? Because as we know, income funds are liquid. You don't have to lock in.
Yeah, I mean, it's such a tough one because, I myself often look at those rates and go, wow. But you just have to consider, I mean, once you're in that, you stuck, there's no liquidity, you stuck for a certain length of time. And it's all very well to look at the rate at the beginning and go, oh, wow, like I'm getting 10% on a fixed deposit or whatever it is, compared to the income fund, which has only achieved 7.5 in history. Going forward where we are and how we've positioned the fund, we really do think we're going to outperform those bank fixed deposits. Plus, this fund offers you liquidity, and it's so I often think, people say, okay, it's giving me 10%, and then halfway through they need to take their money out and they're penalized in terms of penalties, etc. So you have to take that into account and almost reduce that premium that you pay for taking your money out early, in terms of a more realistic return. So I think being nimble and flexible, being able to move the fund, for instance, a bank fixed deposit is one rate. We are taking advantage of those rates. We believe they're also very attractive, but we will take advantage of them in the form of NCDs, which is the professional rate that the banks give big funds like ourselves and others. So we are taking advantage of that. We're just also taking advantage of other asset classes, plus we're giving the client liquidity. So I think you must just, depending on what you want, if you're happy to have your money locked away and not worry about volatility, great, then I don't think it's a bad option. But you have to be very clear on those, on what you're looking for.
I tend to agree with that. And, I myself like that optionality, liquidity. But like I said, some clients are happy to lock in for 5 years. But let's just maybe look at fixed rate notes and the future of fixed rate notes. You've shown the graph on the farm market with yields coming off very late, early or late 2023, early 2024, and it looks like it's dropping sharply thereafter. We haven't really experienced any sort of capital gains from fixed rate notes over the past couple of years. We understand why. Actually, the exact opposite. Do you think that clients can expect, some capital gains coming from fixed rate notes, whatever is held in the portfolio, over the next 2 to 3 years?
Yeah, I mean, we do. I think that's kind of like what we're saying is that, given where yields are, it's from about 13 years onwards, they're above 12%. I can't remember a time when, I can obviously during COVID, etc., but it's very infrequent that yields are here. Look, I know we've got a lot of risks playing economy. We've got Eskom, our lovely friend, who, keeps kind of giving us disappointing news. And this obviously feeds into the growth prospects for this economy, which is a huge fiscal risk, which means the long end of the curve is going to suffer. And that's what we've been seeing, consistently for a while now. I think there's a lot of emotion in the market as well. So there's a lot, when all these things, I'm just thinking about Andre de Ruyter's book that came out over the weekend, and there's a lot of emotion. And what we try and do is look through that. We look at our valuation models, which consist of various, whether it be US Treasuries, inflation differentials, and sovereign spreads, and also I won't get into the technicalities. But we try and estimate a level of fair value for the market, and then we compare where the market is. And at the moment, the market is offering significant risk compensation. So it's offering that huge safety margin, which means we are more comfortable taking some sort of position in bonds. There's obviously debate. It's an income fund. You don't want to go into the long end. So I won't bring all that in, but we will definitely see bonds as attractive in this environment, and we do deem it appropriate to have a position in bonds. But we also are saying that now, because of the fact that monetary policy is tight and might be tight for a while, and real yields are high, that floating rate bonds also are a good option. So it's good to have a balance. And the difference between now and sort of during COVID was there was absolutely no reason to be in floating rate bonds. There was every reason to be in fixed. We were trying to max our duration. So that's kind of what I mean about the differences and how we position differently through them.
Bronwyn, maybe just a very quick question that didn't come through from the audience. I got it through WhatsApp, and that's on property. Hasn't that been a detractor in the fund over the past 12 months, or does it add value? We know SA property is totally oversold. Valuations are very attractive. And like you mentioned, you did touch on property. I think your views are very different to a lot of managers out there. You've got, I think, if I remember correctly, about 3.6.
Unfortunately, Eugene, it has been a bit of a detractor. So, there's always this debate that an income fund, a short term, has a shorter term horizon. So should we be investing in a very volatile asset class like property? However, we have such a positive view on it. But, you know, our investment team has a very positive view, and how we'll implement that is kind of in a smaller way in the income fund. So at the moment, the property exposure is 3.6, half is in offshore, half is in local. And what we've seen lately is obviously with the property market sell-off, as well as the Rand sell-off, that some of that you know, Rand hedge in terms of an offshore property stocks has bailed us out a little bit. But yes, it has unfortunately been a little bit of a detractor. It has got cheaper and cheaper, and we think at valuations that it's at the moment, yeah, there's just so much upside. Plus, we're earning a very high dividend yield on the stocks that we own, which is important for an income fund. So, you know, if we're earning a low dividend yield, it doesn't make sense for an income fund. But the stocks that we've picked have decent dividend yields. So even if the share price doesn't even move from here, we're still getting that consistent yield. And we think, given the sell-off and given the discount to NAV that these property companies are offering, that they're not really going to sell off from here.
Very, very interesting indeed. And I mean, it's something a lot of people battle with, is that property conundrum. And, you know, like I said, if you're looking for a well-rounded fund, well, you'll find all these expertise. Even though it did attract over the past 12 months, it certainly can add a lot of value. And despite that, I mean, you still outperform the bond index and most of your peers. So, Bronwyn, well done with you and your team. Thank you so much for an absolutely great presentation and refreshing our memories while we need to consider your fund or very serious contender in constructing income components. To our audience out there, we're looking forward to seeing you again next week, Wednesday, the 24th of May, where we will be decoding some of the BCI conference of last week. We've had a couple of questions from our audience saying, but, you know, a flurry of information, but what now? So inviting BIP from a portfolio construction point of view, giving us some of the highlights and how to think about that. Bronwyn, to you and your team, thank you so much for joining us this morning. And we're looking forward to engaging with you again in the very near future. To our audience out there, thank you so much for always joining. We greatly appreciate your support.
Thanks, Eugene.
And we'll see you next week, Wednesday. Thank you so much.
Bye.